Hi, and welcome to the Build and Exit podcast. I'm Julie Wilkerson. I started the podcast about 14 months ago off the back of the work I do in my company, Wilkerson Accounting Solutions, where I realised there was quite a gap in the market in mergers and acquisitions, helping entrepreneurs and business owners scale to exit, and knowledge and guidance around how to successfully acquire through buy and build strategies. So I'm really excited today to have David Longford. Hi, David.
Hey, Julie, how's it going?
Yeah, brilliant. Thank you. Very excited for today. Just a little bit of background. So the reason I invited David on is he has a really good story. So David was a sort of commercial director in a business for quite a number of years. And unfortunately, the business owner of that business passed away. The business was probably close to insolvency. And we're going to talk today about David's story about how he went through the transition of buying the shares, how he grew that business and actually successfully ended up exiting that business without any earnout clause and got a very good deal, probably for him and any other shareholders involved. So I think it's going to be a great episode, very inspiring as well. First of all, David, I just want to hand over to you to give a bit about yourself and why you wanted to come on the podcast.
Yeah, awesome. Thanks, Julie. So I'm David. I'm an entrepreneur living in London, and I've been building businesses and had one exit for the last sort of decade or so. I'm currently co-founder of a completely different type of business to the one we're going to talk about, which is a fine art logistics business. But basically, I love entrepreneurship, growing businesses, talking to other people about it, and love the podcast. So that's why I wanted to be on.
Ah, brilliant. So, it's such a great story. So I thought just to start, I think it'd be really interesting to hear sort of how you transitioned from this sort of employee commercial director position to buying the business. Like how did that come about for you?
Yeah, that's a great way to start. So, I mean, as I said, I've always been interested in entrepreneurship, ran a couple of very small businesses on the side of other jobs that I've had. So always had that desire to do something, although never had the idea that was good enough to go for it or the courage, maybe. But I was working, for a number of years in a small publishing business in London. And I basically ran the commercial side, sales, marketing, etc. Had an influence on the company strategy, and it was great. I enjoyed it, really, really great times. But I was itching to do something else, and I really wanted to, as I said, strike out on my own or have more control. And I was having a number of conversations with the founder of the business, who was a kind of veteran of the publishing space, legal publishing space, who had an exit before as well. And, for about a year, we were going back and forth, and I was having ideas of things we could do, etc. So we had a great relationship, and I was always trying to push a bit further as an employee, as you mentioned. And then, unfortunately, after I'd been in the business for a number of years, it happened quite quickly, but the founder of the business became ill. And before he actually passed away, we had a number of conversations where he asked whether I wanted to take over and run the business, because it was inevitable that was going to be the end situation. So that was obviously a very difficult time, but at the same time, I guess he had the trust that I was really motivated to do this, because for a year or two I've been saying I want to have more of a input and control, etc. So we had a great relationship. He also thought I would be motivated. I can see now, and very quickly I became, almost over a weekend, CEO of the company which I was an employee of, as he stepped back. So very unusual situation, but one that left me with a lot of responsibility very quickly, which I wanted, but also responsibility for the staff, for making sure everyone had a clear idea of what was happening and that their jobs would continue, etc. And at the same time, had to make a lot of changes very quickly in the background in terms of finances, company structure, to keep us operating.
Oh. So you became CEO, and then there was, I know, after the death of the owner, there was, well, from what we've talked about offline, when obviously he passed away, and then you started to become a shareholder of the company. I know that was quite a difficult time. So you've gone through a bit about the story of the work in the business. What sort of happened? How sudden because the owner died when you were CEO, did he?
We did the handover as he stepped back,
Yeah.
and unfortunately, it wasn't long before he passed away after that. So
Yeah.
he stepped back at the point where he couldn't continue in the business. Yeah.
And then obviously at that point, I know that you said you had to turn the business around quite quickly, and then he passed away. So what happened? How did you eventually get the shares of that company? Like, I know that was quite a difficult time, probably, wasn't it?
Yeah, I think, looking back, it was an very unusual situation. I think the thing that I did, I'm really happy that I did, was treat the whole situation with respect. I wanted to have a job which had more responsibility. That didn't necessarily mean that I should push to maximize my position in month 1, month 6 even, and try and get as much equity as possible. I think I was a bit young, but I had enough wherewithal to think, well, actually, I've got to treat this really with the respect it's deserving. Make sure the business is actually going to continue and grow, and then have conversations in the meantime with the family to become a partner and an equity holder in the business, which I eventually did buy into. So, one of those things where you just got to kind of work out what is the biggest priority today. Is it trying to say, well, I'm CEO, so I deserve X, Y, and Z? Or is it saying, listen, this is I'm a human as well as a business partner. The most important thing is we go forward today. And if we trust the right people, we'll fix it. And we did. So it took a while, but we got that sorted. Yep.
And I think that's a brilliant mindset, David, because I think you'd be surprised. I think having that mindset going into acquisitions in general, I mean, I know it was slightly different for you because you sort of knew the business, but it doesn't really make any difference if you acquire a business and then you go in that as sort of like a new CEO. I think that sort of approach is really important because I've seen both sides of acquisitions where people are going in and sort of demanding things, and that's when a lot of employees leave. So the culture is really important in general. Obviously, you had a bit more of a difficult situation, obviously, because of the death as well. But even without the death, I think it can be quite a sensitive area for people. So I think that's definitely a really good approach to have. So then how did you discuss with the wife, obviously the widower, because was she a shareholder or did she get shares in probate?
Yeah. I mean, it was a family company. So, yeah, she was a shareholder. And the great setup that we had, and the foresight which the founder had, was to ask his friend, who was a just retired law firm managing director. Great to have friends like that who agreed very generously to come on as a non-exec chairman, sounding board for me, friend. And he very, very tactfully was like the route in which we discussed all these things about equity. So, yeah, it was not just the two of us, myself and the family and the widow, but there was a third party, not a completely disinterested, objective third party, a family friend, but someone who could see that the big picture would only work if we were all involved and had the right motivations. So that was super important. Getting the right people in the director. He didn't really have a lot of experience in software, which is what the business eventually became. And the only reason we were able to sell is because we pivoted hard into software and became a SaaS company. So he didn't actually add value in that world, but he added, enormous value in everything else. And that started with the discussions with the family about how we structure everything.
Yeah, so it sounds like quite a process that you went through, but I think it's really good because I do think people often think when they go into acquisitions, some people, I do think the softer approach seems to be better because I see both. I see people that go with a bit of a hard approach and a bit of a soft approach. And the softer approach, because even without deaths and things, the biggest problem often then becomes with the employees of the company, because you find that the new owners, probably partly because perhaps the business being sold wasn't fully set up. So things that happen is the new owners come in and obviously want to make sure they can pay the deferrals and they want to know what their cash flow is. But when they get in there is none of this reports. So they then start going to people going, okay, so they go to maybe like you, like a commercial director or an ops director or something, right, build me a budget. I want a budget now of what you're spending. And this person's like, well, hold on a minute. I've worked here 20 years and I've never built a budget. So then, but there's no CFO, there's no finance team. And I think you have to get that balance. Is obviously you have to do something because you have to be able to grow keep track and not let the business go under. But I do think you have to have that balance between being sensible of expectations for people and how you go about that.
such a great point, because if you come in, okay, so you put your pressure on yourself as the new appointed CEO to say, you'll hear about this the first 30 days, the first 90 days, you've got to do it. It's got to, and that's true, because what's the point in really bringing someone in if they don't turn the ship around? That's the whole job, right? But on the other hand, you've got a bunch of people there who haven't been aware of the operational picture. If there are financial issues in the background, the team who are hopefully working really hard on the product and the sales and the marketing and everything else, it's unfair to run around like a bull in a china shop shouting about how you're fixing everything that they didn't even know was broken. So you've got to be really careful with the story that you tell. And the story has to be consistent, but also it has to be, tactful. Because in my case, in the background, the company was a very interesting company, do lots of great customers. We always serve multinationals and brilliant law firms, but we weren't doing great, and the operational side wasn't very well set up at all, and the finance side. So growth was okay, a bit slow, let's say, or quite slow. But the most dangerous thing for us in terms of going bust in my first month or few months was cash flow, like it is for many businesses. And so I had to, if we were kind of more than 60K into our overdraft on the day I took over, our overdraft was 70K. So I had like less than 10K to play with, payroll in 2 weeks, bills adding up. We had all sorts of manual processes, which I don't think we're talking like nearly 10 years ago now. I don't think it was crazily for small businesses 10 years ago. You might tell me, Julie, that this sounds familiar to you now, but you've got petty cash, checks, imports between different accounting systems, spreadsheets kind of going between the two that take hours each way. Like the whole system was completely terrible for visibility. It was just impossible to know really where we were. The accountants used to come in, poor guy used to come in for 2 days and sweat over, doing month end. And we never really had a month end, it never really worked. So he'd just come in and struggle for 2 days. So that was the picture. And, again, the employees didn't need to know about that. They didn't need me to shout about how, I'm turning everything around. They just wanted to be told that, listen, this is a great company. We're going up. It's going to take time. Let's do it together. That's the message, isn't it, for employees?
And I think and this is why I think the no money down deals don't generally work. I mean, you had a bit of a different scenario because obviously you were in the situation, you made a decision to acquire the shares to help the business forward. But if you're actively acquiring a business, this is why I think the no money down deals, because I think what people don't appreciate is this culture after the close. Because imagine, for instance, so people that do no money down deals don't have any money for any extra budgets. It's like how you've just said, I only had 10K left. But if you're acquiring a business with no money and now you're expecting the business to pay for those shares, you've got less money probably than the business had before. So, for example, this type of thing, what you're talking about, like when we say, okay, so we want to go in and have a cash flow, for instance, the easiest way for people to do it is to bring in third-party consultants that can help. Because, for example, I've gone into businesses where they didn't have any forecast and stuff, and they've paid for our services to come and help them build it. And actually, it doesn't take a lot of the current employees' time. It's a third-party consultant that wasn't there previously. So obviously, we need input from people, but the time required is less. So it allows the owner to go off and still grow the business. It allows the consultants to come in and build everything with input from the team. So therefore, you do kill two birds with one stone because you're showing your new people, oh, I'm going to invest in you because I'm bringing these people in, and you actually get the job done. Problem is that obviously costs money. So if you're doing no money down deals and you don't have the budgets for these things, this is where it then doubles the problem, because the people come in like a bull in a china shop asking people to do things they can't do. They also have no money for anybody else to come in and help them. And realistically, I believe in most acquisitions, you always need a consultant. I know I've worked in corporate companies. I've worked in companies from little companies all the way through to big corporations, 250, 500 million. And I know that in finance jobs, even if you have a finance team, when you have projects, the team never have capacity to do additional work. That's normally the case. Either the processes are inefficient, but it doesn't matter. You're not going to change the inefficiencies immediately. So if you go into someone that's got inefficient processes, you can't just go to that team, I want you to fix it by next week. That can take 6 to 12 months to fix. The consultants come in to help the processes. And that's just in finance. There are other things, aren't there? There's HR, IT, marketing, but that's why I think the no money down deals cause problems.
You're right. I mean, it makes me think about, let's take that investor in this fictional company we're talking about that puts a no money deal down. And then what are they going to do? Split their time between fixing finance, fixing ops, fixing marketing, fixing everything, and growing the revenue? I mean, it's impossible that everyone's going to be brilliant at all those things. So also, recognize your strengths. If you're good at growing, presumably they buy a business with no money down because they think they can grow it very quickly and get out of this tight squeeze situation. And that takes time and effort on the revenue growth side. So you need someone else to help with these specialist areas. So, in our situation, we didn't have that, but I can see the similarity you're making to that kind of situation where you are really it's a tight squeeze, and you've just got to. I guess the thing is, if you haven't got the ability to bring in consultants, whether it's this situation or whatever situation is, you've just got to make sure the decisions you make in the first month are the right decisions. So when we think about the first 30 days being brilliant, I mean, it doesn't mean you need to put in 100-hour weeks. It means the decisions have got to be 80% plus right, not 100%, but let's say 80%. Like, for example, one of the first decisions I made after seeing, I wasn't really involved in the back end of the finance, but I could see all these, paper trails happening on the desk and stress every month with the accounts, but it was new to me. One of the first decisions I made was to say, listen, I could dive into this rabbit hole as a non-finance, non-accountancy person and think I might fix it. Or I could say, listen, luckily it's mid-March, our tax year ends in 6th of April. Let's start afresh. I'm not responsible for the previous year anyway, apart from the last 2 weeks. Start of April, let's get onto a new system, one that's good, and I got recommended to use Xero. And then everything's just clear. Then everything is digital from day one. We create POs for stuff. Like, I was probably a little bit like PO happy because I wanted everything we spent money on to have a PO. And in small businesses, that might be a bit labor intensive, but I'd do it myself. I'd just say, listen, everything from, a new laptop to whatever, or really small stuff, we just put a PO on it. So everything's nicely recorded, everything's digital. And that was one of the best decisions I made. And if I hadn't have made that decision, even though I did all this other good stuff and we grow the business like massively and sold it eventually, I don't think any of that would have happened if we'd have tried to carry on with our old accounting system. That's how big a decision that was. And even though it felt obvious to me at the time, it could have easily just been, let's crack on for another 6 months and fix this system. What's the point? I know nothing about accounting at that point. It would, you just got to recognize your weaknesses.
And I think that's where I come about when I talk about the budgets, because people will go, well, if I don't have the money, I don't have the money. But this is why think differently at the structure of the deal. Like, ultimately, people are doing these no money down deals and they're paying a certain price and they're paying a certain amount up front. That's why the cash flows are so important. Yep. And it's good to think about this before you get to the first heads of terms, because if people think about the budgets they might need ahead of terms, it might change the deal structure. So perhaps you don't pay quite as much up front. So let's just say you were going to pay, the seller wanted, 65% up front, but you did your calculations and thought, well, actually, I would like 50k spare budget for consultants. Perhaps that takes the 65%. Maybe you can only actually afford to pay 50% with a bit of spare contingency. We'll have the conversations with the seller then. Say to the seller, look, you don't have a finance team, and I know that there's going to be some culture problems when I come in. I don't think it's sensible to pay this amount of money. I think I should only pay 50% because of this. Now the problem is, if you leave that conversation until you sign the SPA right at the end, nothing's going to go anywhere because the seller's going to get a bee in this bonnet. But if you're more aware of this commercially at the beginning, like you can see the problems that the company has, and things like that, then you can be having these conversations at the beginning, because everybody says, oh, you can't change terms. You can change terms. I've changed terms on my deal. The difference is, can you commercially explain that to, and are people aware? That's the biggest thing. And that's where I think, so you don't necessarily, I don't think I think no money down deals are a risk. However, I think you can negotiate, but then the seller's less likely to take a change in thing if they can't see you're putting anything into it. If you're just trying to take everything and trying to say to the seller, well, hold on a minute, I also want to pay you less because of this. They'll be like, well, hold on a minute then, what's your risk? So this is where you have to come for it sensibly. You can find budgets in your DD process, more than likely.
Yep.
But you have to be able to have the sensible conversations and show that what you're putting into it and what you're bringing to the table at the same time. And it doesn't have to be money. Perhaps the seller will be happy that you're putting no money in if they think commercially you can bring something to the business. It doesn't always have to be money.
For sure, yeah.
But you have to be able to show, well, what are you bringing to the table? And who knows, maybe they will take less up front to allow that business to run successfully afterwards if you can show them why.
That's why I think there's a really great point, and it makes me think about, there's so much emphasis on founders asking, what's my business worth? And it's such a wide range, just depending on who the buyer is, what the situation is, what people want to get out of it at the end of it. There is no, objective value to any business. It's really, what the buyer sees in, the potential in it and then the future potential of it. So the key thing in our exit process, which, to fast forward a few years, we pivoted from a publishing company into we had a digital product, but it wasn't very big. So made that the focus of the company, wound down the print magazines and the conferences and the other things we did, and really made ourselves a SaaS company. And then over 4 years later, eventually sold as a SaaS company to an enterprise SaaS company. So it was, a very different business to what we started. But the only reason I think we had a successful exit process, which didn't involve an earnout either, was because really over 18 or 20 months, we invested a lot of time in the relationships. So when you're talking about these conversations about inserting, extra budgets in various points, say, you need to consolidate or do various things, those things are all possible, I think, but they're more possible when you've got a good relationship with buyers. And you can have conversations, like before starting about, what do you think it's worth? What are you going to pay? It's really like just getting to know people. And that's what, I invested a lot of time in that. Potential buyers in my industry, people in my space, and it paid off in the end because I was able to have good conversations with potential buyers and create a competitive process where, we had multiple people bidding, but all of them I could have a good conversation with about what do you want to do with it after and how we're going to structure the deal.
Yeah, and I just think both parties have to be open because, at the end of the day, sellers' books are what they are. Because people always ask me about multiples of things, and I always say the same as you. I mean, in the end, there is a 3-year profit of a company. There is. It's either right or it's wrong. There is an adjusted EBITDA. You can get to a profit value, but then and there is a balance sheet worth. There is a net asset, and it's either reconciled or it's not. So obviously those sorts of things theoretically the seller should be doing because the seller should be all over their books before they go to market.
For sure.
So if the seller can't provide that accurate information, then the buyer's got leverage because the buyer can say, well, can you show me this? And even in top level conversations you can get. I mean, I've done it on my deal. I'm doing a deal where I went to heads, I got accounts, and I could see from the balance sheet that there was potential risks. I went back and asked for information and they couldn't provide it. So we put it in the heads. We said, okay, it's this value, but depending on what happens with these, could potentially change the value. It came back. It was quite a lot of money. They weren't real. There was risks. It was quite high, probably 50% of the overall debtors. So therefore we had to change the structure. But I went back to there was a lot of shareholders involved as well because of the situation. I went back to all the shareholders. I had a call with all and I said, look, this was the heads. This was the reason we did it. And this is the outcome.
Yep.
Can you understand why I'm changing the deal structure? Because obviously we can't take on that liability. And in the end, it took quite a while. Don't get me wrong. It probably dragged it out by a few months because there was a lot of thinking. I didn't try and push. I wasn't trying to, I said to them, I'm not trying to just do you over. Like I wouldn't do that. Like in the end, it is what it is. And this is a transaction. And in the end, everyone's agreed and we've now signed a different deal. So this is the thing. So there's leverage on both parties. And if one party can't provide information, then perhaps there's more leverage from the other side. But then find that out and have those conversations early. So that everyone's aware, because the seller sometimes will be aware. They might know, okay, so I know I don't really have my accounts in order. Sellers probably know that. Sometimes ego can get in the way, so they can, and it's the way you approach those conversations, isn't it? Because if you just come in and go, oh, well, your account's rubbish, you can't give me this, you're never going to get anywhere. But if you can be more sensitive to the approach and realize that, this person's run this business for a lot of years and have those conversations, and it will change everything.
It's fundamental. What you just said about leverage, it's like a game of chess, right? If you push to get a buyer to give you a great valuation and you throw all the, we're AI and we're in this amazing space and it's a huge TAM and all this stuff, and you really push in the very early conversations to to get to heads with a great valuation, and then you've got like a whole world of bad and underneath the table, and then it's only going to go down. It's only going to be painful, and in the end, I guess that's why a lot of deals fail, and you've lost a lot of trust from the initial conversations where you threw a lot of smoke over at the buyer. So I think there's reasons why people do that, and maybe people have to sell, or they have other debts they need to cover with the sale of the business, and they want to. Obviously, there's lots of good reasons for trying to get a deal done in the best possible way. But the way I took it was, look, I'm not going to try and do that. I'm never going to, not because I'm like some sort of ethical superhero. I just saw that it was just ridiculous to try and sell a business. Maybe because it was the family business still as well, and I had a responsibility. So maybe as a founder, it's a bit different. But obviously, I always had that conscientious feeling to us. I can't try and blow smoke up buyers because it's only going to backfire on the family here. So everything from the accounts to our CRM just had to be really easy to understand and clear. And that really helped in the exit process. It was like, I felt like I was in control of the discussions, even though obviously I didn't dictate the terms or the valuation, but I always felt like I'm confident, I'm calm, and whatever comes up, I've got answers. And that really helped.
Yeah, I definitely think if the sellers bore over their numbers, they have a lot more ability to leverage better terms, and ultimately the buyer's always willing to pay more, because if the buyer could just see, oh my god, this business is ran really well, they've got an exit pack, they've got a system, they can give me the information, they will just pay more regardless of the 3 times or 4 times.
That's a great point, yeah.
The fact is they know that 1 times extra in monetary value could save them 6, probably scale them 12 months earlier. And what you've got to start looking at is what's the benefit of the opportunity growth than always trying, I only want to pay 3 times, I only want to pay 3 times. Because let's face it, an extra 0.5 at a time or 1 times, probably over the course of 5 years, is probably immaterial anyway. Because if you can grow that business 3 times over in that 5 years, you'll earn back that 1 times extra anyway. So I just think there's I just don't think people have to keep going into, I only want to pay 3 times, I want to pay the minimum. It's not always about paying the minimum. It's about saying, what can I get from this business in the long run, and go from there, in my opinion.
But to get the buyer to think in that way, I think you understand the things that the buyer needs to see or feel to make them think in that way. And I think probably a lot of sellers or founders trying to be sellers maybe don't understand those things, those triggers that make buyers open up possibilities. They just think maybe it's just about pushing and saying your business is going to grow super fast. And that's probably not the trigger that makes buyers actually think about multiples in a different way.
Yeah, I definitely think so. So I'm just interested to know, because I know we've touched on it briefly, but your sale in the end, I think it'd be good just to touch on it, because I know that you did successfully sell in around 4 years, and you didn't have an earn out. So maybe you can just talk about what that structure looked like, because obviously, to go from what was an insolvent business with a death to then build that up over the course of those 4 years, and then to successfully sell, where you got a good deal, is obviously a full turnaround, isn't it? So I think it'd just be interesting to hear how that sale went through and how long it took.
Yeah, I mean, we grew to about like over £3 million, like $5 million at the time. That was probably like 5x growth over 4 years. So it was pretty good in that sense. And then what we did after a couple of years, we really started thinking about selling, intentionally. And again, this is why it's so important to have the right people involved in your team, even if it's just informal advisors or friends. It's just such a great thing to have people you can turn to. So my chairman, the ex-managing director of a law firm that I mentioned before, was experienced enough to say, look, if we're going to do this properly, we need to have corporate finance involved, because we want to sell to people who can pay and pay a good price. And they are going to want to see a really well-structured exit process. So long story short, he brought on board a couple of ex-Big Four people who had corporate finance guys who had started their own boutique firm. They didn't usually work on businesses our size, but, pulled their arm a bit. And so we had this kind of very much private, not known to the employee base, but period of nearly a couple of years where we were creating an IM, making lists of potential buyers, having meetings, etc., and moving the process forward. It wasn't all easy. I think there was a couple of bumps in the way, but overall we had, it was from the start, it was intentionally not an earn-out. We didn't want that because it was a situation where we had a family that wanted to kind of achieve the best results and move on. So that helped, just being super clear on that. I mean, I think earn-outs don't have to be bad, but obviously I'm glad we didn't have one because, we were able to take money off the table at the start. And it was surprising how I think all of our bidders, were happy with that once we just made it very clear from the start. There wasn't a negotiating point. It wasn't like we're just being hardball on it. It was a zero. So if you're interested, it has to be cash up front. And that's how we go. So very simple negotiation, but very effective. Then it was about thinking a little bit kind of big picture, thinking who would be the potential buyers. Is it people in our software space or people who would align with our space and see value in that? And in the end, it was a big enterprise software company or growing very fast enterprise software company who saw us as a great portfolio acquisition. So what they saw is that we sold, as I mentioned at the start, to multinationals and really great companies, even though we're a small company. Our product was for multinationals, and that was great for them because it was a bolt-on to what they did, but we could carry on as a portfolio company for a short time, and the brand actually still exists. It's still it's kind of run operationally centrally, but the brand is separate. It's just a great complement. So that was something we didn't think about before, but all these help from people like our corporate finance team opened up the idea of let's think about all the different types of buyers and eventually create a competitive process.
Mm-hmm. And this is exactly what you've done that these businesses that don't sell don't do, because our firm is an element of corporate finance. That's what we do. We become accounting partners for people and we help them set up to sell. That's what we do. That's what corporate finance is. Mm-hmm. It's a mix of accounting and probably more advanced accounting, so like CFOs and things like that, because within corporate finance you get a level of skill set of different people. And mm-hmm. You built that, I suppose, exit pack. That exit pack, to me, mm-hmm. An exit pack doesn't have to be an 80-page pack. It's an extended business plan and management accounts that goes into a formal document that becomes this is our business, this is our valuation, these are our terms or our wanted terms, and these are our key things that we can offer. And I can absolutely guarantee, because I know when we used to do these, we used to do a lot of these packs when I worked in corporate for, their shareholders. If people trust information, mm-hmm. you don't get questions, or you get minimal questions. The time questions comes in when people don't trust. So if someone comes and there's a lot of problems, then they'll ask more questions. If people come and when they look at it, they feel more trust, they'll be less likely to dig everywhere because they'll have more trust over the whole process. And that is what I think, that's why you were successful, because you invested in that in that proper corporate finance team. And I speak to a lot of people on finance, and I'm not trying to say that finance is the only entity, it's the only department in the company. Yeah. But I do think finance is probably one of the most important, because I think when people come into businesses, often operationally they understand the business, the industry. So I think things like sales, marketing, and operations, people can easily change. But in the end, if you buy the business for the wrong amount, that's the thing that's going to cripple it. Because what's going to cripple the business is the cash. You can change the sales, you can change the operations, and you can change the marketing. But if your business goes insolvent because you have no money, you can't easily change that. And that's why I think finance is probably one of the most critical areas.
Yeah, you're absolutely right. And with that pack, if that pack put together with the finance team was one of the key reasons, the pack was based on the data and the systems that fed the data. So Xero for us was so important. Salesforce we got after about 2 years, which was like incredible tool for us, and various other systems. So you have to have the data. You can't have paper, literal physical paper floating around. You can't have management accounts that get done once every year. It doesn't work. It doesn't flow up to this great IM document, which is going to give you the best exit. So hard work, but kind of comes from transparency at the start.
Definitely. Oh, I just want to say, David, thanks so much for sharing the story. I think this is brilliant. I think you did so awesome. Well in that journey, and I think this is going to be really useful for people. I think it's inspiring, but also educational, because ultimately this is where people are falling down, in selling their businesses. So I think it's been a great opener. And I just want to say to everybody, all of our listeners, thank you so much for everybody's support. If you do like the show, hit the subscribe button so other people can find our channel. And I look forward to seeing you again soon.